Hey everyone, welcome. Thanks for joining us today. I'm Jerry O'Shea, head of Global Market Insights at Hashdex Asset Management, and with me is Samir Kabaj, our Chief Investment Officer. As I think some of you know, a big part of our mission here at Hashdex is to help our clients make sense of the developments that go on within Bitcoin and other digital assets. And as I think we all know, this is a relatively new asset class that a lot of professional investors are really starting to really wrap their heads around. And so one of the key roles that we think Hashdex plays as we try to educate our clients on this is to help them understand how crypto fits within their portfolios as well as the portfolios of their clients. And today we're going to focus on what I think is probably the number one concern we hear from advisors, from wealth managers, and other institutional investors, and that's around volatility, the volatility of this asset class. So, over time, Bitcoin's volatility has come down, but we saw the reemergence of volatility at the start of the fourth quarter after Bitcoin hit its newest all-time high very early in October. And so today, what we're hoping to explore here is that we're going to look at kind of this reemergence of volatility that's happened here in the fourth quarter and what that means for crypto's investment case going into 2026. And we're also going to save some time at the end to talk about some of the main catalysts that we think are going to help support higher crypto prices going into the new year. And before we get started, though, I did want to mention that we're planning on saving some time here for Q&A at the end. So please feel free to submit any questions at any point throughout this presentation, and we'll try to get to all of them at the end. And second, of course, I need to read a short disclaimer before we get going. This webcast is for informational purposes only, and nothing should be considered the official opinion of Hashdex. This presentation is not an offer to buy or sell, nor is it a solicitation of an offer to buy or sell. Certain information contained herein constitutes forward-looking statements. Due to various risks and uncertainties, actual events or results and the performance of products may be substantially different from those reflected or contemplated in such forward-looking statements. As a result, investors should not rely on such forward-looking statements when making their investment decisions. For any product-specific information, please refer to the appropriate prospectus. Great. So I think, Samir, this is, I think to put it bluntly, not the end of the year that most of us were expecting with regards to prices, crypto prices. If you look back at the institutional adoption that's gone on, the regulatory tailwinds, having a new administration in place that's very favorable to this asset class, new Congress in place, I think we, and myself included, expected us to be, Bitcoin to be well above 100, by the end of the year. And today we're sitting about 30% off of Bitcoin's all-time high, which, as I mentioned earlier, was in early October. So even though Bitcoin's volatility has been declining over time, this has proven to be one of the more volatile quarters in recent years. So I want to start with a very basic question and what happened, right? So what's happened over the course of this year? Maybe to put it more eloquently, can you walk us through what we've seen with regard to the crypto price swings over the course of 2025?
All right. Basic question with a not so basic answer, right? This year has certainly been like a very intense year for crypto. When we look on the macro side, it was a positive year overall for risk assets. When we look on of course, despite the whole volatility around the tariffs and all, when we look on the fundamentals, it's probably the best year in crypto history, right? In terms of regulatory clarity, institutional adoption, new products coming to market, like finally use cases is starting to emerge with regulatory clarity coming from financial institutions. So it's definitely been a great year for crypto. But when we look at the prices, it doesn't look like that. It doesn't look like this year was great for crypto. We started the year with the new administration rally, and that actually started right after the election. So crypto saw a very significant rally after Trump's election with the expectation of more regulatory clarity, contributing for the maturation of the asset class and for the growth of the asset class. On top of this, and we can discuss this later, but we had the very expected 4-year cycle in crypto in which we were set to have a very positive year according to those prospects, according to considering their history rhyming over and over again over the last 4 years. So we started the year with a lot of optimism. And up until February, Bitcoin was the Nasdaq crypto index was up almost 10%. And then right after, what we saw was a 25% drawdown. There was mostly, we can say it was mostly because of the tariff war. So that triggered a whole risk-off movement across all risk assets that impacted crypto very significantly. So despite the good news coming from the administrations on the crypto regulatory side, we saw a very significant downturn on that market. And then we saw throughout the year recovery and actually Bitcoin reaching all-time highs, and even the other assets, Ethereum, also reaching its very significant highs. And this was mostly, because of like favorable macro conditions, like the tech and AI stocks moving favorably. When we look on the specific fundamental sides of crypto, saw very significant progress on the regulatory agenda. So especially after around July, we had the Genius Act being approved. But throughout this period, we had the Bitcoin Strategic Reserve being set. We had the Treasury Department working on the crypto policy. A lot of discussion on Capitol Hill about crypto regulation. July, we had the Genius Act. So this all contributed for a very positive, I would say, summer for crypto overall. And then starting in October, November, saw another very significant drawdown, right? It started with some kind of flash crash that was triggered by, the Trump's tariffs on China that caused some technical implications into crypto. So some specific crypto protocols suffer significantly. That caused some crypto exchanges to liquidate positions, and this caused like an idiosyncratic impact on the crypto market. But on top of all this, what we also been seeing, especially since October, is again like I would call like a self-fulfilling prophecy of the 4-year cycle coming again. So the whole narrative that this asset class has a 4-year cycle. This last year was supposed to be a bull market, and now we might be turning into a bear market. This started to resonate on the crypto native investors, the one that have been in this asset class for a long time. They've been trading those cycles over and over again. So what we've been seeing from on-chain data, and even from data from our ETF investors that we have for a long time outside of the US, we've been seeing investors basically taking profits. So leveraging the fact that Bitcoin has reached some all-time highs to take profits on their positions and wait and see what this cycle is going to hold. And the interesting thing about this is that meanwhile, we've been seeing institutional investors allocating over and over and consistently allocating. We've seen this from institutionals like pension funds, sovereign wealth funds. We've seen this movement also from financial advisors and wealth managers in general. This is the year that finally the major concern that this segment had was lack of regulatory clarity. And now there is regulatory clarity for this industry. There's a lot of things happening, and we're seeing active discussions of increasing or starting their crypto allocations. So throughout this bear market, what we've been seeing is more and more professional investors allocating. So we are in a moment in which basically crypto is changing hands. It's changing hands from long-term investors, long-term retail investors that have been in this asset class for a long time. They're taking profits now. It's a technical profit taking, but this capital is transitioning. Those crypto assets are transitioning to long-term institutional investors and wealth managers. The ones that are not here for the short term, they're not here to trade for tactical trades. They're here for strategic asset allocation. So in general, it's been a great year for crypto, a great year on the fundament side. But when you look at the performance year to date, we're down 5%. So, like not a great year from prices perspective. And this makes us very optimistic about next year because the dissonance between the fundamentals and the prices are very strong. And we're ending the best year so far of crypto in terms of regulation with prices going down. So this says a lot about the potential that we have for this, for the recovery of those crypto prices in the coming months.
You mentioned the 4 year cycle a couple times, and I think a lot of folks that follow this space closely are very familiar with that. But it might be helpful for those that maybe aren't as familiar with the crypto 4 year cycle to kind of walk through what that typically looks like. And the reason I ask you to do that is because I think it would be helpful to know if this cycle is over. You mentioned some of the institutional developments, for example, that are really kind of changing the dynamics of this market. But I think, people are curious to know if what we've kind of expected in the past with this asset class is what we should expect going forward. And maybe if not, what are some of the main reasons why, or main factors that are driving this shift?
Yeah, so we even recently we wrote a letter about this. Our latest notes from CIO talks about exactly this 4 year cycle, and we've been getting this question over and over again, especially from the more crypto savvy investors, the one that have been tracking this asset class for a longer term. So for those who don't know, like crypto, in the last 12 years or so, we have been seeing a very consistent behavior, a very consistent 4 year cycle. And this cycles, it tends to go like this. You have 1 year of a bull market. And it's not like any bull market, it's a bubble, right? We saw that 2013, 2017, and 2021. It's a very intense bubble in which like Bitcoin and crypto is out there. Everyone is talking about this. People are, piling in money and entering like some kind of speculation frenzy. And after this year of, very significant bull market, like it happens in any bubble, we normally see popping, right? So we normally see like another year of a very significant bear market. So big corrections following this bubble-like bull market. We normally see 1 year of that type of correction, and then 2 years of prices trading basically sideways. So those three phases we like to call the bull phase, the bear phase, and the recovery phase. In the bull phase, everything is super optimistic. Bitcoin is going to replace the dollar, and like all those big, very bullish narratives. During the bear phase, is on the contrary, it's the end of Bitcoin. Now Bitcoin is going to zero, and all those things, they're all speculation and tulips and all those narratives around this asset class having no intrinsic value. And then we have just 2 years of indifference in which crypto goes out of mainstream, goes out of the conversations. People don't care about it anymore, about this anymore, until we see another cycle coming again, another bull market forming up, and then bubbles creating, and the deserved corrections coming right after. There are a few reasons why we believe those cycles has been so consistent. You have, of course, the fact that Bitcoin's monetary policy follows a 4 year cycle. So every 4 years, we have what we call the Bitcoin halving, in which it's basically its inflation drops by half. And some people argue that if you have a scarce asset in which you have a predictable inflation rate, prices are driven by supply and demand, and the marginal supply drops by half, and the demand remains constant and actually keeps increasing, you see like a very significant shock on its prices. So that might be one of the reasons why we see a bull market. We see a bubble-like scenario every 6 months after the Bitcoin halvings. The other reason we've been seeing is the liquidity cycle. So since 2008, what we've been seeing is most of the central banks synchronized into a liquidity cycles like that last around 4 years. Also in terms of liquidity easing and tightening the economy. And the third reason is the behavioral biases of the investors, right? So those biases, the fact that crypto has been mostly in the last 15 years driven by retail, means that it's very subject to speculation bubbles, right? So those three factors combined, they might explain why we've been seeing those 4 year cycles in the last 4 years. And then the big question is, according to those that believe in the cycle, the month of October was exactly the end of like a 12-month bull market, and now we're supposed to see a 12-month of a bear market. So the proponents of this 4 year cycle theory, they expect that the next 12 months will not be positive for crypto, and actually you might see very significant corrections. And There's some arguments to be made that and I think that the most tricky forwards in the history of the financial markets is this time is different, right? So it's very dangerous to say that, but there are some reasons to believe that we might not see this very synchronized 4 year cycle this time. The first reason is we haven't seen a bubble. So we're seeing here the year's performance. We certainly seeing like prices are great for Bitcoin. So we were way above the last all-time high. We saw a rally in the end of the last year after Trump's election. We had a very positive year overall, despite ending now it's with -5%. But we can't say that we have seen a bubble in crypto prices in the last 12 months. That's just not the case. We haven't seen, although all the excitement on the regulatory side hasn't converted into excitement on prices directly. And this is to your point, Jerry. You mentioned in the beginning, most of the crypto enthusiasts, they have been expecting more from this last few years, like this last year. And certainly, people are expecting to see Bitcoin at 150 or $200,000 by the end of this year. So we haven't seen a bubble. So there's not much reason to see a very significant sharp correction. Like we saw in the other cycles, and the other cycles we're talking about like a 60 to 80% drawdown. So we don't see any significant reason to see a sharp drawdown this time because there's no excess of excitement in this asset class at this moment. And the second big reason that we think this time might be different is because of the money changing hands. So crypto assets are changing hands. This is happening consistently over the last 2 years, especially since the introduction of the Bitcoin ETFs, but it has accelerated significantly this year. So it's changing hands from retail investors, in which most of the time are driven by momentum. They're momentum traders. They buy when prices go up, they sell when prices go down. And this asset class is changing hands to institutional investors. So institutional investors, they take longer to make their decisions, to make their investment decisions, but they tend to be more sticky assets. They tend to rebalance their positions when they see extremes. So when we see extreme greed or when prices are going like very significantly going up, those investors are taking profits and rebalancing their portfolios. When prices are going sharply down, we normally see those investors buying and rebalancing this position. And again, we've been seeing this with our investors, with Hashdex investors, like our ETF investors. We have those in Brazil for a long time. We have those in Switzerland for a long time. We're starting to have more and more investors here in the US. And what we've been seeing consistently is that those types of investors, the financial advisors, the wealth managers, the institutional investors, they see this type of drawdown as an opportunity to build those positions. So while we're seeing like the whales, the retail, long-term retail investors selling now, we're now seeing institutional investors buying. So this might create an environment in which we might not see very significant corrections. It's also because this volatility is way lower now. It's not reasonable to expect the prices are going to double or triple in a few weeks or months like it happened in the past. But we also don't expect to see very significant sharp corrections like we saw in the last few cycles.
Yeah, and I think on the institutional side, there's a few things that have happened recently that I was a little surprised at them happening as soon as they did. These were kind of things that I had on the agenda for 2026. But just in the last couple of weeks, we have Bank of America announcing that private clients could get up to 4% crypto ETF access. Morgan Stanley announced a few months ago a similar allocation recommendation. Vanguard, a firm that has long been skeptical of this asset class, now announced that it's going to allow trading on its platform, Bitcoin and other crypto assets. So I think it's interesting timing, right? Because I think obviously people are paying a lot of attention to the price, but as you mentioned earlier, there's a lot of these underlying institutional developments that I think folks maybe aren't paying enough attention to. And so maybe before pivoting over to talk a little bit more about kind of the macro and monetary side of things, I would love to get just a few thoughts from you around how you think this kind of entrance of traditional financial institutions into this space is going to evolve in 2026.
So yeah, a lot of things that were not in our bingo cards for 2025 have happened, right? And we can even start with the US, basically naming Bitcoin as a store of value and starting a strategic Bitcoin allocation. So in our thesis of Bitcoin as an emerging digital store of value, we thought the US would be the last country to adopt such a store of value because it's a direct competitor to the dollar dominance, right? But here we are. The other big surprising development we saw is from JP Morgan, right? So Jamie Dimon, like historically very skeptic about crypto. He said like a few years ago, he went out saying that he would fire anyone from JP Morgan that would buy cryptos. And now he's saying that crypto is here to stay. He's saying that tokenized assets are coming and they're going to take over the economy. And JP Morgan is launching its own stablecoin. So certainly it's been a year in which finally the financial institutions are coming to this market. And the reason why is regulatory clarity. Again, now there is clear rules of the road. There are, like you see on the SEC and on the CFTC, a clear guidance to give clarity to this industry. And we believe this movement is only going to accelerate. We talk about this in length in our crypto outlook. With the rise of stable coins, we believe that all the big financial institutions and all the big tech companies, they are currently integrating stable coins rails into their payment systems. So this is going to cause a very significant shift because like we saw with the internet back in the 90s, and the transformation that the internet brought into information is the same level of transformation that blockchain will bring to financial assets. And if all the media industry had to reinvent itself and had to integrate the internet back in the early 2000s to evolve, the same will happen to the financial institutions. They will have to evolve over the coming years to embrace crypto, to integrate crypto into their processes. Otherwise, they're going to just be disrupted by the neobanks, the fintechs. They are using crypto to provide more efficient financial services. So I think it's a trend that's here to stay. And we're only going to see more and more of those financial institutions integrating crypto, integrating on the technology side, integrating on the asset allocation side, on the investment side. So yeah, we definitely think that this was not like a isolated case happening this year because of changing the administration. This is certainly a big shift on the winds for crypto.
Yeah, then I want to we might touch upon a little bit of this later, but I do want to just ask a more kind of macro question. You talked about the liquidity conditions shifting, and we have the Fed that cut yesterday 25 basis points, but no clear sign that those cuts will continue into 2026. A lot of folks are arguing that with QT, quantitative tightening, ending, and the Fed announcing that they're going to be purchasing short-term treasuries, that we might be moving more into a period of quantitative easing, which obviously helps risk assets and crypto in particular. So I'd love to maybe just get your thoughts around how you're reading kind of the higher level macro liquidity conditions, how those are being set up in your mind for crypto prices in 2026.
So first, it's important to recognize again that crypto is a risk asset class. So Bitcoin, although its thesis is that as over a digital store of value, it is a risk asset, right? So the investment case for Bitcoin now is, the fact that this technology is maturing, the fact that Bitcoin will become a consolidated store of value that's going to be used by central banks, etc. And this is only going to happen as volatility goes down, as adoption goes up. But right now, Bitcoin is a risk asset, and crypto is a risk asset class. So they tend to react to macro conditions the same way you would expect, the tech stocks and the AI stocks, right? So they're very sensitive to macro conditions. And if we see an environment in which we have more liquidity in the economy, which is, you can argue that's almost inevitable considering that the US will keep monetizing its debt. So we don't see much, of the space to have like structural tightenings. Then it's positive for risk assets, and this is positive for crypto. So it's positive tailwind for risk assets. It's going to be positive for crypto. If we are in a situation in which the Fed is required to tighten its monetary policy, it's going to be bad for risk assets. It's going to be bad for crypto. So as simple as that. And again, that's why we we also see this behavior in crypto that although the fundamentals are completely different from that of the U.S. economy, we tend to see a higher short-term correlation to tech stocks, while the short term, while in the longer term, we see lower correlation to tech stocks. And the reason why is the fundamentals are different, but the macro environment that they're in, they affect tech stocks the same way that they affect crypto.
Yeah, and I know you've been on the road a bunch just in recent weeks, New York, Miami, Dallas. I'm probably missing some cities there, but um, there was a recent survey from Charles Schwab that said 45% of advisors plan to invest in crypto in 2026. And, getting back to things that have surprised me, that actually is something that did surprise me. It was right on par with fixed income. And if you had asked me a few years ago, they were told me that advisors would be looking at crypto in the same kind of way that they're looking at fixed income. I would have been shocked, but I think it's a sign that things are certainly shifting. And so, in the conversations you've been having with allocators, with advisors, how are the questions changing around this asset class? Because I know, from my own personal experience, even at the start of this year with the new administration, there just seemed to be a lot more curiosity, and that seems to be accelerating. But would love to get your thoughts around that.
Uh, so what we're consistently seeing is the conversations are shifting from, is this even something that I should consider in a client's portfolio? Isn't this just like a speculation mania? To how how can I integrate this into a client's portfolio? So 1 year from 1 year ago or 2 years ago, most of the conversations were, why, why does this has a value? How can I think about this from a valuation perspective? What is the investment thesis for crypto and for Bitcoin? What are the applications, right? So how, like, what can I use? What are the different applications I can use crypto for, and how they're going to create value? Is this a thing? Is stablecoin a thing? Is tokenized assets, like, does it make any sense to have tokenized assets? And now the conversations are completely different. So we see here consistently, what we hear consistently from advisors is, I get this. This is here to stay. I won't fight this anymore. This is here to stay. And now I need to figure out, how to deal with this in my portfolio. Uh, like, what size should I look into? Is it like on the tactical sleeve, on the strategic sleeve? What should I take it out to replace it? Is it part of my alternatives bucket? Um, the most common question now, surprisingly, is capital markets assumptions, right? So how can I bring this into my general capital markets assumptions, how I model my portfolios, and how I look at the future. So yeah, definitely, like, the big shift that we've been seeing from professional investors is the conversations going from why to how. This has been very consistent, and again, across Latam, across Europe, and now across the US. The big difference that we're seeing here in the US market is um, advisors, they took longer to get in, of course, because of lack of regulatory clarity and lack of investment vehicles, right? So ETF is a very recent vehicle here. Crypto ETFs are very recent for the US investors, but they are moving way faster than we saw in other markets, and they are going to a higher overall allocation on average. So on average, the conversations we're seeing, the advisors are talking about a 3 to 5% allocation in the US, and what we've been seeing, like, in countries like Switzerland or Brazil, it's like 1 to 3%. So what I can say about the US investors, and again, having this context of speaking with investors from around the world, is they're definitely way more active. They're more risk tolerant. They understand that this is to say. They understand the the value of under strategic asset allocation, of having a model portfolio and using this as a diversification tool. And most importantly, they understand the power of indexing, of passive investment, not trying to pick the winners. So those are very big, different conversations that we've been having this year around crypto.
Crypto is very obviously a space that's driven heavily by narratives, and we've talked about the macro conditions, the volatility that we've seen, and I think it might make sense to spend a few minutes looking forward. And Hashdex just released our 2026 crypto investment outlook a couple weeks ago, and there's some dominant themes that we identify in that report. And Samir, if maybe you want to touch upon those just at a high level. I think you have a slide here. Yeah. If maybe just touch upon what we see in terms of the themes that are going to develop in the coming months and beyond, and then we can move to some questions. I see we've got a few questions so far, but folks, feel free to submit questions if you have them, and we'll try to get to them in the last 10 or 12 minutes that we have left here.
Sure. So every year, every end of the year, our investment strategy and research team gets together to discuss, what happened this year and what to expect from next year, right, for the coming year. We've been doing this consistently for the last few years, and I could say that, from all the outlooks that we have produced so far, this one is the more insightful in terms of actual applications of crypto and the impact, the direct short-term impact that they might have on prices. And this is because, again, we've seen the US markets finally moving. So the US market has been basically avoiding crypto. The regulatory environment has been of a crackdown since 2018. That's mostly because of the ICO boom, right? There was clearly some, exaggeration, I would say, in terms of expectations there. That has caused a very significant regulatory backlash. And then after 2022, when we saw the FTX collapse, that caused another big wave of, regulatory crackdown. And now with this new administration bringing regulatory clarity to the space, especially with the Genius Act and the now, being discussed now, the Clarity Act, we've seen a completely different environment in which, the SEC is now saying out there that tokenization is here to stay, and they need to embrace this. Financial institutions need to embrace tokenization. This is going to make our markets more efficient. This is going to keep the U.S. capital markets relevant in the 21st century. So we're moving from a posture that the regulators were trying to slow down this industry and crack down this industry to regulators that are trying to accelerate adoption, to keep the dollar dominance, to keep the U.S. dominance in the 21st century. And this has caused, like we discussed before, a big change on not only the financial institutions, the institutional investors, but also how corporations have been adopting and embracing crypto. And we have decided to highlight three major aspects to it. The first one is the stablecoin market, right? So stablecoin has been we've been seeing exponential growth in stablecoin adoption in the last few years, and that adoption has come mostly from emerging markets, come from countries like Venezuela, Argentina, Nigeria, China, Brazil. Actually, like I was looking at the numbers, 2024 saw like a record outflow of US dollars from Brazil, and 30% of all the dollars in circulation that exited Brazil last year, they went out through stablecoins, right? So 30% of the dollar flow coming out of a country as big as Brazil went through stablecoins. That's a very significant adoption. But we haven't seen much adoption in the US. We haven't seen much adoption in Europe, and that's mostly because of lack of regulatory clarity. And now we are seeing a completely different environment in which the Treasury Department is saying that stablecoins is the path for the dollar dominance in the 21st century. And they want to push for adoption. And this is creating a very significant wave in which the European Union now has to adopt they're embracing also stablecoins. They need to have your stablecoins to compete with the dollar. Otherwise, they're going to lose control over their monetary policy. So all countries are moving out for stablecoin adoption because the US has given us that clarity. Uh, Stablecoin, or what we call in this outlook, the crypto dollars, they are a path for having a universal instant payment mechanism that any citizen, any corporation worldwide can send payment to anyone in real time using the dollar. So that's why this administration is saying that this is the path for dollar dominance in the 21st century. And we believe that this has only started. This market cap, and this is, there's a lot of forecasts from different players, different financial institutions, and even from the Treasury Department that talks about, the stablecoin market reaching from like anywhere from $2 to $5 trillion in market capitalization until 2030. And this is again because it's time for the developed economies to adopt stablecoins. This is coming. We see now, the big financial institutions either setting up their own stablecoins or partnering up with tech companies to build their own, to offer stablecoins. The tech companies, the big tech companies, also embracing this and offering payment rails. Visa, Mastercard, all the big like Swift, all the big payment rails are integrating into stablecoins. So this is a very significant topic, and we expect this market to at least double in the next year as the US comes, as we unleash the entrepreneurial spirit of the Americans and the US economy on this specific segment of the economy, on stablecoins. So we expect this to at least double next year. And of course, this is going to be very significant for how can I benefit from that? The smart contract platforms underlying those stable coins. So every stable coin transaction needs to be transacted, needs to be both like registered on a public ledger on a blockchain of one of those smart contract platforms, such as Ethereum or Solana. So they tend to benefit very significantly from this wave of adoption. This is also the technology, I could say like maybe the Trojan horse for Bitcoin, because this is going to make basically all the payment institutions, all the fintechs, all the financial institutions have to integrate digital wallets, have to integrate digital payment rails and digital wallets. And once this is all integrated, the migration towards Bitcoin is going to become way easier, right? So this tends to happen as well, especially as the stable coins are forced basically to be backed by short-term US treasuries. And we're seeing, the central banks worldwide selling long-term treasuries. So you see, in one aspect, we're seeing a big movement towards de-dollarization from central banks. So reducing their holdings on US treasuries, and then normally doing this selling long-term treasuries, while stablecoin issuers are buying short-term treasuries. This has the potential to shorten the overall duration of the US treasury. And again, like reducing its appeal as a store of value. So this is certainly a big also tailwind for Bitcoin. And the implications of this, of course, is like we can have like a faster borderless payment system that will allow anyone to send payments in real time. Corporations can finally use this for cross-border settlement and for trade financing. We see like a big shift on the demand for US debt and the duration of the US debt. And Bitcoin might also, stand out as a clear non-sovereign store of value that anyone can access in real time. So this is the first big trend that we're seeing, and we expect to see a significant acceleration throughout next year. The second big trend is the growth of tokenized assets, right? So right now, this segment of the blockchain technology called tokenized assets, or some call it RWAs, right? So real world assets. This is a $30 billion market. Stablecoins are now close to $300 billion. So 10% of the financial assets on chain are real world assets, if you think that way. So it's 10% financial assets, 90% dollar, 90% cash. And when we look at the real economy, this number is the contrary. So we normally see like 10 to 15% of cash and 85% of financial assets when we look at the overall like real economy. So as money um, becomes more and more on chain, as the dollar becomes digital, the next natural demand from users, from investors, from corporations is going to be investment. It's going to be money market funds, treasuries, bonds, corporate bonds, equities, and all those things are going to be tokenized. And now we can say this is a consensus now among all the big financial institutions, among regulators, among policymakers, that tokenization is here to stay and is going to grow significantly in the coming year. So that's why, as the US adopts the stablecoin, as we expect, stable coins market cap to double in the next year, we expect real world assets or financial assets to tokenize 10x faster. So we might grow from $3 billion, from $30 billion in tokenized assets to $300 billion as we put in more $300 billion of cash on chain. So a 50-50 mix, I would say, throughout the next year would not be unreasonable to expect, especially if we keep seeing higher interest rates, which reduce the incentives of just holding cash, right? Just holding crypto dollars. And again, this is very positive for smart contract platforms and to decentralized finance applications. So decentralized finance is a very interesting segment of crypto, is a very interesting investment thesis. But if you look right now at applications, like who are using decentralized finance applications? Mostly crypto degens, trading meme coins, right? So that has not a very significant economic value to it. But once assets are tokenized and cash is tokenized, and all those assets are available on the blockchain, and we can use the smart contract to offer financial services, those applications will become extremely useful. So we might see a big transformation on how that segment is seen, from a segment that has been known for just facilitating speculation and meme coin frenzy to something that can be the foundation of a new financial market that all financial institutions will leverage to make their processes just more efficient. Instead of writing a software and having to run reconciliations and have like humans running all of this, they can offer the same type of service using smart contracts with a fraction of the cost that can be run like 24/7 without intermediaries. So we expect this to be a very positive wake-up call to crypto applications, to decentralized finance applications. And the third big wave that we're seeing is this intersection between crypto and AI, which remains to be a very, I would say, VC-driven market. It's still very nascent. But given the fact that AI has been growing exponentially and AI demands have been growing exponentially, and crypto is also growing exponentially, those two things combined tend to be very significant. So what we've been seeing in terms of big adoption, decentralized AI infrastructure. So the big bottleneck for AI now is infrastructure, it's energy and compute. We're seeing like the tech companies building data centers like never. And guess what? Like we all have cell phones and computers that 90% of the time are idle. So we could use that computing power to help AI compute to get to get a financial outcome, to get a financial incentive to contribute to the network. And this is a very significant trend. We're seeing blockchain and staking being used for verification also, to make sure that they're doing like correct verification and coordination between agents. And most importantly, I think the one that most resonates with people is, think about it, like we are in the age of AI agents. We're seeing the emergence of AI agents. They'll be able to execute more and more complex tasks. They'll be able to do things for us to make our lives more efficient. But they don't have a social security number. They don't have a bank account. They don't have a credit card. How they're going to pay for things? They're going to pay using stablecoins. They'll have the digital wallets. So you can have AI agents with digital wallets that go around shopping for you, that go around, hiring services from you, from both like from humans, from companies, but also from other AI agents. And and once cash and assets are tokenized, we can have AI agents offering financial services for us, from financial advisory to all types of like complex financial transactions and financial planning. We could have AI agents as CFOs, personal CFOs to us, and corporate CFOs for companies. So all those things, they need the blockchain rails. So AI agents, they will not. It's very unlikely that we see AI agents setting up their bank accounts and having to deal with wires and all those legacy financial pipes. So overall, like those three forecasts that we have, like the stable coins doubling in market cap, 10x growth in tokenized assets, and this AI crypto market growing to $10 billion, which is still very small, but we believe next year is going to be a milestone year for that team specifically. Makes us very optimistic about the crypto fundamentals. And again, 2025 was a great year on the crypto fundamentals. We think 2026 is going to be a great year for fundamentals. 25 wasn't that great for prices. So what should we expect from 2026? I don't know. I don't know how long this is going to, translate into price action, but I can say, Jerry, I'm more optimistic than ever.
Yeah, we've got a few minutes left here. I was just looking through the questions, and I think we've touched upon a number of them. Question around tokenization that I think you talked about. There's one topic that we didn't get to that someone asked a question about, and I'll take the liberty of providing a little bit more context, but it's around digital asset treasury companies, in particular strategy. So the companies, these companies that have, in particular in 2025, been a big source of demand for Bitcoin specifically. And the question is around what you think. What do you think the impact of strategy being removed from the MSCI in January will be? So, in other words, the largest digital asset treasury company strategy has about 650,000 Bitcoin in it. It's currently being considered to be removed from the MSCI index going into next year. And so I think the question is around what the impact to the market will be of something like that.
So treasury companies has been a very hot topic throughout this year, right? And does it make sense for a company to hold Bitcoin as a treasury assets? Bitcoin as a store of value, being a good store of value, or becoming a good store of value, it would make a lot of sense. So we think that more and more companies will have Bitcoin on their balance sheets. Of course, what strategy is doing and what Michael Saylor is doing specifically is a whole other level. Like, so they transform strategy into a Bitcoin financial company, a Bitcoin hedge fund, which the core thesis is allowing, like, so using the capital markets to increase the Bitcoin holdings per share, right? And since he started very early and with very smart treasury strategies, I think we can say his Bitcoin would need to go down very significantly in order to cause any kind of stress for strategy specifically. For the other crypto treasury companies, like every company has its own situation, but they might be in a way more fragile situation than strategy. But I would say overall, looks like strategy is in a very strong position, and that would only change if we see like a very significant drawdown on Bitcoin prices. So I don't anticipate that being removed from indices, from MSCI or others, is going to cause a very significant impact on the crypto market overall. It might have a short-term impact on the prices for strategy, of course, because all those passive funds holders of MSCI will have to sell that position. So we might see some short-term stress, but as long as this doesn't contaminate, and as long as this doesn't, as long as we don't see a very significant Bitcoin correction because of this, and again, I don't see a reason for that. I don't think it should have like a direct impact into crypto price action.
That's great. And I think we're a little bit over time now, so I want to be sensitive to people's time and thank you, Samir, for the conversation today. For those that are listening, you can go to hashdex.com to get in touch with us or visit our Insights Hub. The outlook that Samir gave a very high level overview of is available on our website and goes into a lot more detail around what we expect in 2026. So encourage everyone to take a look at that. And with that, I'll thank everyone once again and best of luck in the new year.
Thank you, everyone. Thank you, Jerry.
Take care.